What if I told you there was a mortgage that could let you afford any house that you want, but you'd still be paying on it when your kids go to college? The 50-year mortgage just got announced, and I've run the numbers, and what I found is going to shock you. Hi, I'm John Wells, a mortgage lender and branch manager with over a decade of experience in the lending space. I've helped thousands of people just like you achieve their goals while being budget and wealth conscious. Now, over the weekend, President Trump posted a picture comparing himself to President Roosevelt, promising to bring us the 50-year mortgage, just like how Roosevelt brought us the 30-year mortgage after World War II. And listen, at first glance, this sounds like great news. Lower payments, easier to qualify, and more people can buy homes. But here's the thing that nobody's talking about. I've spent the last few days running the actual numbers, looking at real client scenarios. And what I discovered is that this could be one of the most dangerous financial products to hit the market in decades. But before we get into that, if you're serious about becoming a homeowner and you want to know exactly where you stand right now, I've created a free home readiness questionnaire. It takes about 3 minutes and it'll show you exactly what you need to work on to qualify for the home that you actually want. The link is in the description below. Now, here's what we're going to cover today. First, I'm going to show you the real math behind a 50-year mortgage. Not the sales pitch, not the marketing, but what you'll actually pay. Then I'm going to walk you through a real scenario with actual numbers, so you can see exactly what this means for your wallet. And here's the part that surprised even me. I'm going to show you the one specific situation where the 50-year mortgage might actually make more sense, but it's probably not what you think. And finally, I'm going to give you 3 alternatives that could actually help you buy a home without trapping you in 50 years of debt. But first, let me tell you about someone I worked with last year. Her name was Sarah. She came to me frustrated because she couldn't qualify for the home that she wanted. She was making decent money, about $70,000 a year, and had good credit, but the monthly payment on a 30-year mortgage was just too high for her debt-to-income ratio. Now, if the 50-year mortgage had existed back then, she probably would have jumped at it. Lower payment, qualified for the house, problem solved, right? But here's what would have happened had she took that deal. By the time she paid off that house, she would have paid almost double the interest. And not in 30 years like a normal mortgage, in 50 years. And of course, that's if she kept the house the entire time, which statistically she wouldn't. Let me break down the history real quick because this matters. Back in the 1940s, Americans had thousands of veterans coming home from World War II. The government wanted to help them buy homes, so they created the 30-year mortgage. Before that, most mortgages were much shorter, maybe 5 or 10 years, and you needed massive down payments. The 30-year mortgage changed everything, and it made homeownership possible for regular people. And today, over 90% of homebuyers choose a 30-year mortgage. It's predictable, it's fixed, and it works. But here's the catch that most people don't understand. In the early years of a 30-year mortgage, almost all your payment goes to interest, not the house, to the bank. Look, I'm going to show you a chart that makes this crystal clear. In year 1 of a typical 30-year mortgage, maybe 90% of your payment is pure interest. By year 10, you're still paying mostly interest. It's only after about year 15 or 20 that scale starts tilting and you're actually building real equity. But here's the problem. The average American sells their home after just 12 years. This means that most people never even get to the good part of the mortgage. They sell, they move, and they start over with a new 30-year term. So even though you think you're building wealth, you're really just paying the bank interest for a decade and then restarting the clock. Now, let me show you what happens with a 50-year mortgage. And this is where things get really scary. Let's say you're buying a $500,000 home and you put down 20%. So you're borrowing $400,000. On a 30-year mortgage at 6% interest, your monthly payment is about $2,400. On a 15-year mortgage, it jumps to about $3,300 per month. Now, here's where the 50-year mortgage comes in. You'd think it would drop your payment way down, right? Maybe save you $500 or $1,000 a month? Well, that's wrong. With a 50-year mortgage at 7% interest, and trust me, the rates will be higher because the bank is taking on way more risk, your payment would actually be about $2,600. So you're saving maybe $200 a month, and that's it, $200. But here's what you're giving up. With a 30-year mortgage on that $400,000 loan, you'd pay about $860,000 total over 30 years. And with a 50-year mortgage, you'd pay over $1.5 million You're paying almost double the amount of money to save $200 a month. And listen, I know what some of you guys are thinking right now. You're thinking, well, John, but $200 a month matters, and I could actually use that extra cash flow. And you're right, it does matter. But let me show you what that actually costs you over time. And if you're serious about making smart financial decisions with your home, I've put together a free calculator that shows you exactly how much equity you'll build with different loan terms. It's called the Home Equity Builder Calculator, and you can download it right now from the link in the description. It'll show you side by side what a 15-year, a 30-year, and even a 50-year mortgage will actually cost you in real dollars. Now, let me tell you about Mark. Mark came to me 6 months ago looking to refinance. He bought his house 2 years ago with a 30-year mortgage, and he still owed $311,000. His payment was $2,217 a month, and he was feeling a bit stretched. And he asked me if he should refinance into a lower payment. Now, if the 50-year mortgage had existed, he might have been tempted to stretch out that term and cut his payment. But here's what I showed him. After 2 years of payments on his original 30-year loan, he had paid down about $15,000 in principal. If he refinanced to even a new 30-year mortgage, he'd be restarting the clock. All that amortization building he'd done, gone. He'd be back to paying mostly interest for another decade. So instead, we refinanced him into a 20-year mortgage, and his payment actually did go up about $50 a month, but he's now shaving 10 years off of his loan, and he'll save himself over $100,000 in interest. And that's the real power of understanding how mortgages actually work. Now, here's the part that really bothers me about the 50-year mortgage idea. It's being sold as a way to make homes more affordable, but it doesn't actually make homes more affordable. It makes the debt repayment look smaller. There's a huge difference. Affordability isn't about how low your monthly payment is. It's about how much you actually pay for the house. And with a 50-year mortgage, you're paying way more. You're just spreading it out so thin that it feels manageable. But here's the real danger. Let's say you buy that $500,000 house with a 50-year mortgage. You make your payments for 12 years, which is the average time people keep a house. And after 12 years, do you know how much principal you've actually paid down? It's only about $32,000. That's it, $32,000 over 12 years. Now you decide you want to sell, and you've got to pay 6% to realtors, and you got to pay closing costs. That alone is $30,000 right there. You've basically lost your entire equity position, and if the market dips even a little bit, you could owe more than what your house is actually worth. You'd be trapped. You couldn't sell without bringing cash to the closing table. And this is the scenario we saw happening to millions of people in 2008. And we're setting up for a similar trap all over again. Now, before you click away thinking this is all doom and gloom, stay with me because I'm about to show you the one scenario where a 50-year mortgage could actually work. But first, if you're finding this information helpful and you want to see more content that helps you make smart money decisions with your home, go ahead and hit that subscribe button right now. Here's a scenario where a 50-year mortgage might actually make sense. So let's say you're facing foreclosure, you've fallen behind in your payments, maybe you lost your job or had a medical emergency, and the bank is about to take your house. Right now, there's something called a loan modification. Banks can modify your existing loan to make it more affordable so you can keep your home. Sometimes they extend a 30-year mortgage to 40 years to lower your payment. A 50-year option could be another tool for that. It keeps you in your home, prevents foreclosure, and gives you some breathing room. But here's the key. It's a last resort tool to prevent you from losing your home. It's not something you should choose when you're buying a house. There's a massive difference. The other scenario, and this is actually really important, is if you're very strategic about it. Let's say you get a 50-year mortgage to qualify for a home you otherwise couldn't afford. Your payment's low enough to manage, but here's what you do. Every time rates drop, you refinance and shorten the term. You keep your payment the same, but you move from 50 years, 40 years, then from 40 to 30, and then from 30 to 20. You're consistently cutting down the length of your loan while keeping your payments stable. This way, you're using the 50-year mortgage as a stepping stone, not a destination. But let me be very clear. This only works if you have discipline and you actually follow through with refinancing. Most people don't. They get comfortable with the payment and they never refinance. And that's exactly how you end up paying $1.5 million for a $400,000 loan. Now, let's talk about why banks hate this idea. See, mortgages aren't just loans, they're investments. When you get a mortgage, the bank doesn't just hold on to it forever. They bundle it up with other mortgages and they sell it to investors. Those investors make money from the interest you pay. The 30-year mortgage works great for this because most people refinance or sell their properties within 10 years. The banks get their money back relatively quickly and they can reinvest it. But a 50-year mortgage, that's honestly a nightmare for investors. If rates go down and you refinance, the investor loses their income stream. If rates go up, you never refinance, and the investor is stuck with a below market return for 50 years. Either way, they lose. So they're going to charge you a higher rate to make up for that risk. And that's why you'll never get the same rate on a 50-year mortgage as you would on a 30-year mortgage. The risk is just too high. And that higher rate means that you're paying even more over the life of your loan. Let me show you something that nobody else is talking about. Right now, there's a law called the Qualified Mortgage Rule. It says that for a mortgage to be considered safe and qualified, it can't be longer than 30 years. This rule exists to protect both lenders and borrowers. If the loan is qualified, the lender gets legal protection if something goes wrong. And if it's not qualified, the lender takes on all the risk. A 50-year mortgage would likely be non-qualified. That means that banks would charge even higher rates because they don't have that legal protection. So not only are you paying more interest because of the longer term, you're also paying a risk premium because the loan doesn't meet safety standards. And it's a double hit against your wallet. Now, let me give you 3 real alternatives that could actually help you buy a home without destroying your wealth. First, if home prices are too high, wait and save a bigger down payment. I know that's not exactly the sexy answer, but it works. Every extra dollar you put down is an extra dollar you're not paying in interest for 30 or 50 years. Second, consider an FHA loan with a low down payment, but make extra principal payments whenever you can. Even an extra $100 a month can cut years off your mortgage and save you tens of thousands in interest. And third, look into down payment assistance programs in your area. Many states and cities have programs that help first-time homebuyers with down payments or closing costs. You might qualify for thousands of dollars in help that you don't have to pay back. I've worked with clients who've gotten $15,000 or $20,000 in assistance, and it made all the difference in being able to afford the home that they actually purchased. Here's another strategy that works incredibly well. Buy a smaller home first. I know, everyone wants their dream home right away, but what if you bought that starter home that's a little bit smaller or in a little less trendy neighborhood? You get in at the lower price, you build equity for 5 to 7 years, and then you sell and use that equity as a big down payment on your dream home. This is how real wealth is built, not by stretching yourself into a 50-year mortgage, but by being strategic and patient. I've seen this work over and over again for my clients. They start small, they build equity, and within a decade, they're in the home they really wanted with a reasonable mortgage payment and real wealth being built. Now, let me address something I see in the comments on videos just like this. People will say, well, John, I want to save up for a bigger down payment on my home, but I'm afraid home prices will continue to go up and I'll never catch up. And look, I get that concern. Home prices have always been going up, but here's what I want you to understand. If you buy a home you can't afford with a 50-year mortgage, you're not building wealth, you're building debt. I've seen this work over and over again with my clients. They start small, they build equity, and within a decade, they're in the home they really wanted with a reasonable payment and real wealth being built. Now let me address something I see in the comments on videos like this. People will say, well, John, if I wait to save up a bigger down payment, home prices will go up and I'll never catch up. And look, I get that concern. Home prices have been going up recently, but here's what I want you to understand. If you buy a home that you can't afford with a 50-year mortgage, you're not building wealth, you're building debt. And if the market turns even a little bit, you could risk losing everything. Is it really worth it to rush into a bad deal just because you're afraid of missing out? I'd rather see you wait that extra year, save up properly, and buy a home that actually builds your wealth instead of draining it. And honestly, if home prices are so high that the only way you can afford one is with a 50-year mortgage, that's the market telling you something. It's telling you that prices could be inflated, and maybe it's not the right time to buy right now. I know that's hard to hear, but I feel like it's the truth. Now let me tell you one more story and then I promise I'll wrap this up. I had a client last year named David. He really wanted to buy a house. He was tired of renting. He wanted to build equity. All the right reasons. But his budget was tight, and the payment on a 30-year mortgage was going to be about $3,000 a month. and that was pushing his debt to income ratio to the limit. He asked me if there was any way to make it work. Now, if the 50-year mortgage had existed, he probably would have taken it. But instead, he decided to wait another year, and now when he came back to me and asked, he decided to wait another year. Now, when he came back to me, he asked me about a 50-year mortgage, and I showed him the numbers on what it actually would cost him over time. We calculated that over 50 years, but instead, he decided to wait another year. Now, when he came back to me and he asked me about the 50-year mortgage, I showed him the numbers on what that actually would cost him over time. We calculated that over 50 years, he'd pay almost $1 million in interest alone. And when he saw that number, his jaw dropped. He said, "John, that's insane. I'd be paying on this house until I'm 80 years old." So instead, we came up with a different plan. He had saved up an extra $15,000 for a bigger down payment, and we found him a house that was slightly smaller, but in a great neighborhood. His payment came in at $2,600 a month on a 30-year mortgage, thanks to his extra down payment and rate shifting lower. And now he's building real equity. 3 years from now, his home will have appreciated, he'll have over $100,000 in equity, and he'll be on track to pay off his house in his 50s, not his 80s. And that's the difference between making a smart decision and falling for a gimmick. So here's my bottom line on the 50-year mortgage. It's not innovation, it's financial denial. It's pretending that homes are affordable when they're not, and it's kicking the problem down the road and hoping somebody else deals with it. And the people who will suffer the most are the buyers who don't understand what they're getting into. They'll see that lower monthly payment and get super excited. They'll sign the papers, and 20 years later, they'll have realized they've barely made a dent in their loan balance. They'll be trapped in a home they can't sell without losing the money, paying interest for decades longer than they should, and watching their wealth disappear into the bank's pockets. Now, if policymakers really wanted to make housing more affordable, there are much better ways to do it. You could increase the amount of profits you can take tax-free from when you sell a home. Right now, it's $250,000 for a single person or $500,000 for a married couple. Raise that to $1 million and adjust it every year for inflation. That would encourage longtime homeowners to sell and free up inventory. You could also let people transfer their existing low interest rate mortgage when they buy a new home. If you got a 3% mortgage and you want to move, you should be able to take that rate with you. That would unlock so much frozen supply in the market, and you could also raise the mortgage interest deduction limit. Right now it's capped at $750,000. Raise it up to $1.5 million to reflect today's home prices. These 3 moves would do more for housing affordability than any 50-year mortgage ever could. So let me recap what we covered today. A 50-year mortgage might sound like a great idea because it lowers your monthly payment, but the math doesn't lie. You'll pay almost double the interest over the life of the loan. You'll barely build any equity in the first 10 or 20 years. And if you need to sell early, you could actually end up underwater, owing more on the home than it's actually worth. The only time this makes sense is as a last resort or to prevent foreclosure, or if you're extremely disciplined about refinancing every few years to shorten the term. For everyone else, it's a trap. Instead, focus on saving a bigger down payment, looking into down payment assistance programs, or starting with a smaller home and making extra principal payments when you can. These strategies actually build wealth. They don't just hide the cost of debt. Now, I want to hear from you. Drop a comment below and tell me, do you think a 50-year mortgage is a good idea or a disaster waiting to happen? Have you ever been in a situation where you wished you had a lower payment, even if it meant paying for decades longer? Let me know your thoughts below because I read every single comment and I love hearing your perspectives. And if you're thinking about buying or refinancing your home, please click the link below to schedule a free consultation. I would personally love to be your mortgage expert and help educate you, as the wrong decision can cost you thousands. And don't forget to grab that free home equity builder calculator from the link in the description. It'll show you exactly how different loan terms affect your wealth over time. And if you found this video helpful, make sure you subscribe so you don't miss the next one. I'll see you there.